This week's chapter is chapter 7. We're going to be learning about the asset market, as it says here, in particular, the market for money and how that's related to prices, the price level, and inflation in the economy. So this is the last market for our model. And back in chapter 3, we had the production function and the labor market. Then in chapter 4, we had the goods market with desired investment and desired saving. And then this is going to add in the money market or asset market. And that makes up our complete macroeconomic model. In the other chapters, in chapter 8, we're going to be talking about business cycles. We're going to be moving to talking about the economy in the short run and business cycles. In chapter 9, we're going to bring all these markets together in a single model, ultimately leading to aggregate demand and aggregate supply, something you learned about in principles of macroeconomics. Now we're going to see where the aggregate demand, aggregate supply model actually comes from. It comes from all of these markets. So back to this market, the market for assets, the market for money is what we're really going to focus on. As you can see here, the different sections of the chapter having to do with, and we can see it over here on the contents for the chapter as well. So first of all, we're going to look at what is money. What do we mean by money? That's actually something that's covered in principles of macroeconomics. That should be a review. You should have seen that and should bring back some things to you from that course. And then we're going to talk about how people decide on how to hold their wealth. In other words, their portfolio allocation, how they hold their, what kind of assets do they hold on to in terms of their wealth. And then in particular, we're going to look at a particular kind of asset, money. So we'll talk about the demand for money. The Federal Reserve controls the money supply. So we're going to have a demand and a supply for money. And then we're going to think about that in terms of asset markets. And we're going to show that we can focus to think about all assets in the economy. We can just focus on the market for money, and that will tell us equilibrium in all the other asset markets as well. And then we'll finish up this chapter by talking about what's the relationship between the growth rate of the money supply in the economy and the inflation rate. So the first part of this chapter, the introduction, kind of outlines all of that and emphasizes the role that money plays in the economy. So that's the first section, right? Talking about what is money. So we can think about money in a variety of ways. We all have some common understanding of what money is, but there are technical definitions of what money is in the economy that are important for the Federal Reserve, important for us to understand in terms of carrying out monetary policy. This is actually a really useful in touch with the data and research, Money in a Prisoner of War Camp. This is a famous article actually by Radford talking about what kinds of things can serve as money. In this case, it's cigarettes in prisoner of war camps in World War II. And it makes the point that money could be a variety of things, could be anything, in fact. What matters for money are the properties that it possesses, things as a way of pricing things, as a way of keeping value and holding on to value over time, as a means of payment, a medium of exchange for other goods and services. And there have been a variety of things, many things over time that have served as money, including cigarettes, tobacco, furs, gold, other coins, etc. So that's a useful and interesting little vignette. I encourage you to read that. So talking about the functions of money, the one that we're most used to probably, that's most common, is money as a medium of exchange. We use money to buy things, right? Buy and sell things. It's used as a unit of account as well. It's how we price things that we're buying and selling. And it can also serve as a store of value. In other words, income that you don't spend today, you can store it as different kinds of assets, but in particular, money. It's a way of holding wealth, as it says here. Oh, what do we mean by that? So there are different ways of technically measuring the money supply, the amount of money in the economy. So we call these monetary aggregates, right? Those are the different measures. So there's M1, which includes sort of the base level of money in the economy. M1 includes currency and traveler's checks, transactions accounts. We normally think of those as checking accounts. But the technical term is transaction accounts, things you make transactions on. And then there's M2, which includes M1, but then includes also savings deposits, including money market deposit accounts, other kinds of time deposit, money market mutual funds. So these are oftentimes things that you would find in banks, but not only in banks, but that's where you would find a lot of these savings and loans, commercial banks, other kinds of places where you would tend to hold on to income that you haven't spent in order to get some interest on that money, some return on that money. So it serves as a store of value, but they're also, right, currency checking accounts, right? You can use to buy things, right? Your money machine card, your money market card is not money, but it is tied to the accounts that are money, right? In the same way that credit cards are not money. We can buy stuff with them, but only to the extent that there's actual money in accounts that you can pay off the credit card balances behind the purchases. Otherwise, your credit card will cease to function if you can't pay your bills, right? So those are not money. It's the things behind them that supply the purchasing power in terms of the medium of exchange function of money. But these different kinds of accounts can also serve as a store of value. Right? So again, there's some short vignettes about the monetary aggregates, M1, M2, and the money supply has to do with those monetary aggregates. That's what we're talking about. Right? There are other kinds of monetary aggregates that the Federal Reserve looks at as well. But M1 and M2 are the most common, perhaps, right? So the money supply is the amount of money available in the economy, meaning those kinds of money market mutual funds, money market deposit accounts, savings accounts, checking accounts, and currency, as well as traveler's checks. Okay. So those are the monetary aggregates. That's what we're thinking about when we think about the money supply. We can think about monetary policy, and when we do that, this section of chapter 7.1, section the first section of chapter 7. There we go. At the end of that section, it's talking about how the central bank, the Federal Reserve in our case, carries out monetary policy, and it carries it out through open market purchases and open market sales. And those are simply buying government bonds from the public or directly from the government, but the Federal Reserve buys bonds, government bonds, in the open market, right? That's why they're called open market operations. And by doing that, they either increase or reduce the money supply. So as it says here, for the rest of the chapter, assume that the economy has a money supply of M dollars, which is determined by the Federal Reserve. It's not dependent on the interest rate. It's not dependent on anything else. It's just given, and the Federal Reserve can change that through its monetary policy. So we're going to focus mostly on money demand in the middle part of the chapter. So demand for money is just one kind of demand for assets, right? So we want to look at how is it that people determine how much money they choose to hold relative to other kinds of assets, right? So people can hold their wealth in a variety of ways. Money is just money in a banking account, for example, in a savings account is only one example of that, right? Stocks, bonds, other real estate, other kinds of things are also ways that people could hold their wealth. And those decisions are called portfolio allocation decisions, how to hold your portfolio and what mix of assets. So what determines that? Expected return, right? Things with higher expected return are things that are going to increase the demand for a particular asset, right? But along with the expected return, you've also got things like risk as well. And then we're going to talk about liquidity, time to maturity, et cetera. All of those things come into play when making decisions about what kinds of assets and the quantities of the different kinds of assets that you're going to hold on to. So oftentimes the assets that have the highest potential reward also carry the highest risk. We might think about stocks, right? They can be a great source of return on your wealth, all right, and holding that wealth in terms of stocks from private companies. But there's also a great deal of risk associated with that because stock prices can go up and they can also go down. So you can lose money on that asset as well, right? So risk matters as well. Liquidity, how easily you can turn an asset into something that you can use to buy goods and services, how easily you can turn it into money, into currency, into a checking account balance, into a savings account balance. Right? So some assets are more liquid than others. Sometimes houses, for example, that's a type of asset that people could keep their wealth in. And depending on the market, it may be easy or it might be hard to sell a house, depending on the market, depending on where we are in the business cycle. And so liquidity, somebody could, for example, have to sell a house, but if the market is saturated with houses, and they would have to sell it probably at a loss in order to become liquid, in order to get the cash they need to, say, pay off other bills or to move somewhere else, et cetera. Right? So liquidity matters as well. Time to maturity matters. We think about this in oftentimes in terms of financial securities like bonds. Right? How long is it going to be until that bond actually comes due? And so the longer the time, the more risk there is of fluctuations over time. So we'll typically think of, along with this expectations theory of the term structure, term means how long, dealing with how long to maturity, right? That longer term bonds, 30-year bonds, for example, probably have higher interest rates associated with them than, say, a 10-year bond, because you have to hold on to it for a much longer period of time. And the risk of bond prices changing over that period of time, in order to compensate you for that, you need to have a higher return. That's not always the case. There's something called the yield curve that plots the interest rate for different maturities, 6 months, 1 year, 5-year, 10-year, 30-year bonds. And typically that's upward sloping. That's what we call the yield curve. But sometimes it gets inverted or pretty flat, depending on people's expectations about the future of the economy, future of Federal Reserve policy, et cetera. So this time to maturity oftentimes matters as well. Okay. And there's some useful examples that are discussed here. Right, we talked about this term premium on long-term bonds that's higher than the expectations theory, based on a series of shorter-term bonds that could lead up to that 3 10-year bonds that would lead up to that 30-year bond, for example. Right. So we've got some examples there about that. So another way we can think about assets, not just in terms of their liquidity and risk and expected rate of return, but in terms of their characteristics. So bonds, stocks, right? We could have real estate, etc. Homeowners, right? Housing for most people, is their biggest asset, their biggest way that their wealth is being held. So others, some of their assets, like it says here, could be in the form of things like automobiles and furniture, antiques. Some people have wine collections, and they have them because they think they're going to increase in value over time. Paintings, other things like that. Those are all different types of assets, ways that people hold their wealth. All right. So this talks about different kinds, different types of assets that people might hold, whether it's money that's in the bank and savings accounts and checking accounts, bonds, stocks, etc. And you can see over to the right the percentages overall of total assets in the market, in the marketplace or in the economy, and how those are held. Right, a lot of people have money in pension funds or retirement accounts. Right, stocks are, along with real estate, are the biggest percentages of assets that people hold, along with those retirement accounts, pension funds. So you can see the distribution of the different kinds of assets that are held. These right in here, currency, checkable deposits, time savings, and other deposits, that's what we're talking about in terms of M1 and M2, right? So it's just part of the total assets that people hold. And we're going to ask questions about, well, why do people hold on to money, M1 and M2, rather than these other assets, right? So what matters for that? So that's coming here. So asset demand, people want to diversify their portfolios generally, so hold a variety of different kinds of assets. And then we can talk about a particular asset that we looked at the very beginning of the chapter, and that's money. So why do people hold on to money? Remember, money, M1, M2, currency, checking accounts, savings accounts, money market deposit accounts, money market mutual funds. But we can think about this primarily, perhaps in terms of the transactions demand for money, medium of exchange, function of money, right? We can think about purchasing goods and services, although it's some people keep money in savings accounts as a store of value as well. So it says here the things that have the most effect, the greatest effects on demand for why people hold on to money: price level, real income, real GDP, and interest rates. So that's what you're going to see throughout and going forward. Money demand is a function of the overall price level, the level of real income in the economy, and interest rates. So this section then is going to talk about each one of those factors, how it affects the demand for money. So the price level matters, right? Because if prices are higher, you need more money to buy stuff, right? So money demand is positively related to the price level. It's directly related to the price level. Real income. As real income goes up, you're going to tend to want to buy more goods and services. And people with higher incomes make larger purchases as well. And so, with more transactions, with more spending on goods and services, you're going to need more liquidity to buy those goods and services, more money in your checking and savings accounts. So even if you have a money market card that you use to buy things, or a credit card, you're going to need to have money in your savings account or your checking account in order to pay off those bills at the end of the month. Right? So the amount of money that's demanded increases when real GDP, real income, increases. Right? That's the upshot from this section. And what about interest rates? Well, interest rates they're like a price, right? And so the interest that you get, you can think about this as the expected return on money versus non-monetary assets, right? So an increase in the expected return, for example, on money increases the demand for money, increase in expected return on alternative asset, right? Non-monetary assets causes holders of wealth to switch from money to other kinds of higher return alternatives, and that lowers the demand for money. Okay, so there's some examples here where it's going through some actual examples with dollar figures, right? And it talks about the role of the real interest rate versus the amount of money demanded, right? So we're going to sort of think about, because all interest rates tend to move up and down together in the economy, we're going to assume that there's just one real interest rate that measures the nominal return on non-monetary assets, right? So when we think about the real interest rate, we're thinking about the return on non-monetary assets. Back in chapter 2, we learned about the real interest rate. The real interest rate is the nominal interest rate, I, minus the expected inflation rate. So it's the rate of return that you have after accounting for inflation. And it's the real interest rate that we are focusing our attention on. Okay. There is interest rate that's paid on money, right, in bank accounts, savings accounts, some checking accounts. It's quite low, or they're different, but they're quite low. We're just going to assume there is an interest rate on money. And so when we talk about the real interest rate, it's the real interest rate on non-monetary assets relative to the interest rate paid on money, M1 and M2, checking accounts, savings accounts, balances, for example. Okay. So that's what we're talking about. We talk about the real interest rate. So this is what we have in terms of money demand function, and money demand for money is directly related to the price level. Right? As the price level goes up, you demand more money because it costs more to buy stuff. Right? So it's directly related, 1-to-1. That's the assumption here. And then times this liquidity function, right? Is what that L is really for liquidity. Right? So we need liquidity to buy things, and that's related to real output. Right? So money demand is directly and positively related to real GDP, real income, because with more real income, people spend more, and as they spend more, they're going to need higher money balances. So there's more money demanded. Okay, it to be more liquid to be able to buy those goods and services. And then we have the interest rate, which is on non-monetary assets, and the real money demand is inversely related to that. What we're going to actually do is take this P, we're going to bring it over to the other side, divide both sides by P. So it's going to be real money demand equals a function of the real GDP and the rate of return on non-monetary assets. Remember that I is made up of the real interest rate plus expected inflation. So expected inflation is in there as well. Okay. So, and that's what this is getting at right here. Right. So the real interest rate plus expected rate of inflation. And here we bring the P to the other side. As I said before, that's the equation. That's the demand for real money balances, or this is the money demand function. Depends on real GDP, the real interest rate, and the expected level of inflation. If we were drawing that money demand curve, real money demand curve, with the price of non-monetary assets on the vertical axis, right, and real money demand and real money supply on the horizontal axis, that it would be a downward sloping curve, just like a demand curve, normal kind of thing that you would expect for a demand curve. And what affects where that demand curve is, what shifts the demand curve? Changes in wealth, right? If wealth increases, people want to spend more money, and they need to hold on to higher balances in the bank, for example, to pay the credit card bill, to money market or money card purchases, etc. Right? Risk right? We learned about that earlier. The higher the risk of holding on to money, right? Or the risk of alternative assets, right? So if alternative assets get riskier, like stocks, right? And there's a lot of volatility in the stock market, people are going to tend to hold on to more money, right? So the demand for money is going to change in that case. So here are the things that cause changes in the demand for money. It's another one of these summary boxes. Those are important in each chapter. The thing that is unique in this list is the real interest rate. That is a move along the money demand curve. Everything else will shift the money demand curve. We want either to the right or to the left. Why does any of that matter? So if we have a demand and a supply curve, and we assume the Federal Reserve can keep the supply curve wherever it wants through its monetary policy, then the key is the Federal Reserve has to estimate where money demand is in order to determine where the money supply should be in order to keep the real interest rate at its target level that it wants to have in the economy. The Federal Reserve is focused on the real interest rate and setting that real interest rate through its monetary policy. So it needs to know where money demand is so it can adjust money supply accordingly to hit whatever target it's trying to hit. Right? So these are all things that can affect money demand they need to take account of when they carry out their monetary policy. Right? Liquidity of alternative assets, payment technologies, all those things that are in this list. So one of the things that's interesting, right? Alternative technologies has to do with Bitcoin, cryptocurrencies, right? So that's another way that people could hold their wealth, and some people do, right? So that can affect the volatility of Bitcoin prices, for example, and other types of cryptocurrencies, right? There are many now, not just Bitcoin. As those prices change, that's going to affect how much people want to hold on to in the form of money versus cryptocurrencies, right? There's an issue with liquidity with currencies like Bitcoin. You can use Bitcoin to buy some things, but many fewer things than you can with, say, dollars or checks in the economy. So this is related also to how much money people want to hold on to. And then we can talk about the elasticity of money demand. So how much does money demand change, for example, when real GDP changes? So elasticities just have to do with percent changes in money demand versus percent changes in another variable, like real GDP. And then, so the Federal Reserve needs to know how much, not only that money demand is going to change when real GDP changes, but by how much. And the elasticity of money demand helps to tell them that. Okay. So that's the reason for that section. And then we have this thing called velocity, the quantity theory of money. This is a historically one way to think about money. Velocity is a term that simply means the amount of nominal GDP, the amount of spending on goods and services in the economy, divided by the amount of money that's in the economy, or P times Y divided by M. Right. So it's, so if there was $1,000 worth of nominal GDP and $100 worth of money stock, then it'd be 1,000 divided by 100, it'd be 10. So the velocity of money, each dollar bill has to exchange hands 10 times, essentially, right, to purchase that nominal GDP with that given money stock. Okay. So we can think about whether, the velocity of money. You can see the M2 velocity of money is relatively constant, right? M1 velocity, not as much, but M2 velocity is relatively constant, relatively stable, right? Changes over short periods of time, but But over longer periods of time, it's been around 2, although it's gone down in recent years, right? And so we can use that to think about what's the relationship between what's called the quantity theory of money. Real money demand is directly related to, in a constant way, to real GDP, right? So we can think about real money demand just primarily in terms of real GDP in that case. That's assuming that K is, right, K, to go back up here, right, this is the velocity, right? So MV equals PY, which has to be true. The amount of money times the velocity is equal to the amount of transactions or spending overall in the economy. If we bring M and P to the other side, it's equal sign, and V, 1 over V to this side, that's where we get this equation. That's where this equation comes from, right down here. Okay. So velocity is constant, doesn't depend on income or interest rates, then we can directly link real money demand to real GDP. Okay. But you can see, yeah, it's not a perfect relationship. If that was the case, these things would move together perfectly, nominal GDP and real money demand, or in this case, it's real money supply, right? But it's not a perfect relationship there. So that's another way to think about money. What you'll notice in this chapter is that this is the first place that the price level has come into play in our model. And so the money market is where the price level comes into play, and we'll do adjusting, especially in the long run, to the economy, to anything that gets the economy out of long run equilibrium. Price level will do the adjusting. And then the question becomes, how quickly does the price level adjust? So section 7.4 is talking about asset market equilibrium. And really the basic idea here is that we're saying, and what the authors are saying, is that if we find equilibrium, right, here's a total amount of wealth, right, for a simple example here, right, and then here's the overall amount of wealth, that's for an individual. Here's overall money demand plus non-monetary asset demand has got to equal the amount of supply of that, right, which is this down here, the supply of non-monetary assets and money has to equal the demand in equilibrium. That's what this equation down here is saying, right, that money demand minus money supply plus non-monetary demand minus non-monetary asset supply, right, excess demand for money plus excess supply, demand for non-monetary assets has to equal 0, right? And if we unbundle that, we can, so what that means is the only time that we have equilibrium, right, is when money demand equals, or when, let me put it this way, when money demand equals money supply, this is 0, right? Money demand equals money supply. That's M is money supply. If these two are equal, this is 0. But overall, these two have to equal 0. And so that means that the market for non-monetary assets, right, also has to be in equilibrium, where non-monetary asset demand equals non-monetary asset supply. So what it says, we only need to think about one of these, and we're going to look at the the market for money. And if we find equilibrium there, we're going to have equilibrium in the market for non-monetary assets. So we don't need to look at the whole thing. We can just focus on the market for money, money demand and money supply. All right. So now asset market equilibrium simply means the amount of real money supply in the economy equals the amount of real money demand. Okay. So that is our equilibrium condition for the asset market. This is the equilibrium condition for the money market. Okay. It's important to read these pieces down here. It says we made the assumption that the economy is at full employment. All markets are in equilibrium. When we get to chapter 9, we're going to eliminate that assumption, and we could be out of equilibrium. We could be beyond full employment or less than full employment. And in that case, what we're going to see is that prices are what do the adjusting. And when prices change, that's going to change the real money supply. And that's going to change equilibrium in the money market. It's the price level that's going to do the adjusting to bring the economy back to full employment, back to long-run equilibrium. What we've been talking about up to this point in the course, it's the price level that's going to do the adjusting to bring the economy back to equilibrium. So the difference between the Keynesian and classical economists, if you go back to chapter 1, is their assumption about how fast the price level adjusts. If it doesn't adjust very quickly, the economy can be out of equilibrium for a long time. That's the Keynesian model. And if you believe that the price level adjusts quickly, that's more like the classical model, in which case we're going to move to full employment relatively quickly without any intervention needed by, say, government, the Federal Reserve, in the economy. Okay. So the rest of this chapter, right, is talking about over here. You can see the money growth and inflation. So it's just going to reconfigure the relationship that we had up here from the equilibrium condition, right? We're going to bring P over here, and the L function, liquidity function, money demand, underneath over here, right? Or no, we're going to keep it there, sorry. We're going to keep P over here, right? And so we bring L down below, all right? So we can use this equation to talk about how money is related to the price level or changes in the price level or inflation. Okay? So it says the price level depends on money supply relative to money demand. We can see already if the money supply is going up faster than money demand is, then the price level is going to get bigger. It's going to be more inflation. Okay. So price level, money supply, those two are linked. Right. So money growth and inflation. This is a way in this last section of the chapter, it's really getting into more detail about that. So the equation that we just saw at the end of the last section in terms of percentage change can be written this way. So the change in price over the price level, this is like the consumer price index, the P here, right? That's the inflation rate. That's what we mean. It's percentage change in price level. The inflation rate is equal to the percentage change in the money supply minus the percentage change in money demand. So if money supply is growing faster than money demand, then we're going to see an increase in inflation. Okay. That is what that's saying. If we assume that money demand is related to changes in real GDP, then if the real money supply is growing faster than the and this is the elasticity of money demand with respect to real GDP, if it's growing faster than this whole piece right here, right? The elasticity times the percent change in real GDP, then we're going to get higher inflation, right? So if real GDP is growing at a constant rate, let's say 3% per year, and it's not really changing, then what we should see is that increases in the real money supply, right, or the money supply, I should say, not nominal money supply, not the real money supply, lead to changes and increases in inflation. So we should be able to see in a graph, for example, right, that as the growth rate of money increases, we should see higher inflation. So in many, many countries, if you look at many countries, you can see that positive relationship. The higher money growth associated with higher inflation, low money growth, low inflation. Right. So this is just one example of that. And we can think about the inflation rate, nominal interest rate. Normally, nominal interest rate moves along with the inflation rate to keep the real interest rate relatively constant, not exactly. So you can predict nominal interest rates partly on what you expect to happen to inflation. Inflation and the nominal interest rate tend to move, as this is showing, right? Tend to move together, right? The inflation rate, nominal interest rate, not perfect, but they move pretty well together. Okay. So this is chapter 7, right? There's a summary, chapter summary that you should look at as well. That puts kind of everything into perspective. We started out by talking about what is money. What do we mean by that? How do people hold their wealth? Money is just one way that they do that. And so we can, but money is, we can talk about why people hold on to money. And then we can talk about the role that money plays in terms of the overall asset market. And so we can break that market into non-monetary assets and monetary assets. And if we find equilibrium for the monetary assets, money, in other words, money demand and money supply, we find equilibrium in the non-monetary asset market as well. Why do we focus on the monetary asset market? Because that's where the Federal Reserve carries out its Federal Reserve monetary policy. And we want to be able to say things about that. So that is chapter 7 in a nutshell. There'll be some other additional reading related to monetary policy by the Federal Reserve as well. But this is going to be our final new market in our model: money demand, money supply. Right? We haven't seen the graph here. We can go to chapter 9 and see that. But you can think about, this is the market, the money demand and money supply, and the Federal Reserve is the one who directly affects the money supply to hit whatever interest rate target they are trying to hit.